Disney shares moving higher as an activist investor takes new aim. Third Point Capital's Dan Loeb calling for the media giant to end its $3 billion annual dividend and to use those funds to create more Disney Plus content. Loeb writing a letter to Disney CEO Bob Chapek saying the ability to drive subscriber growth, reduce churn, and increase pricing present the opportunity to create tens of billions of dollars in incremental value for Disney shareholders in short order and hundreds of billions once the platform reaches larger scale. For more, let's bring in Rich Greenfield, media and technology analyst at Lightshed Partners. Rich, great to have you with us. You've been a Disney critic for a long time. You have a sell rating on the stock, and you've actually called for a lot of these things that Mr. Loeb is calling for himself. I'm wondering, though, because back in May, Disney announced that it would suspend its dividend for the first half of the fiscal year. Is there a thinking at all that maybe that dividend doesn't even come back, that there isn't even a dividend to reallocate?
You know, look, I think right now Disney's obviously facing some sort of the perfect storm of challenges, right? I mean, you've got theme parks that, some of them are still closed, like California, and Newsom was out today. Governor Newsom was saying that they're not opening anytime soon. The Florida parks are open, but again, open is a technical term. There's well under 50,000 people in all of Walt Disney World on a daily basis right now. Normally, there's 150 to 160,000 people on an average day, and so the parks are pretty empty. Yes, overall, they're in a tough standpoint from the parks. Obviously, the cruise ships obviously are not in operation. You look at the movie business, can't release a movie probably till sometime late or middle to late of next year. They're in a really difficult position. So I think in the near term, the dividend is probably going to be centered around, or they're probably going to be suspending the dividend until the business is back up and running the way it normally would be in a sort of when we've dealt with COVID. But we 100% agree with everything Loeb argued for in that letter. We really think that's what Disney needs to do. If they want to become Netflix, they've got to pivot their business dramatically faster than they are right now. They're just doing this in an incremental step function rather than just going all in and really taking the opportunity and seizing it.
I mean, do you think that it should want to be Netflix? Why does it have to be Netflix per se? I mean, doesn't it need all of the other elements to its portfolio in order to create the flywheel that makes that content more attractive to subscribers who probably also, by the way, have a Netflix subscription?
We did an analysis that looked at what were Disney's revenues. So if you look at Disney's movie revenues or the studio revenues that Disney creates, you could actually add both Disney Studio and Warner Brothers Studio, and Netflix is now generating greater revenue and is on its way shortly to generating more profit than those two businesses. And so I think the reality is when you look at the scale that subscription video on demand, SVOD, Netflix, when you look at the scale and the economics that brings you, there is a far greater kind of pot of gold on the other side moving to streaming than living in this world of first we put it out in theaters, then we put it out on DVD, and then it ends up in HBO, streaming, whatever, in terms of that window. Just going full streaming. And the reason I have my background today, I've got Simpsons, Mickey Mouse Club, and Moana behind me. Those are the trending titles on Disney Plus. Like, this is what Loeb is talking about. There's no new content on Disney Plus. They're not producing enough content. Those three shows have been like number one for almost the entire first year of Disney Plus. They need to get far more aggressive with the content they're spending on. I think moving movies, getting rid of windows and putting more movies like Black Widow, like they can really gun the movie side, but they also can just spend more money on TV shows and other forms of content as well.
Hey, Rich, it's Dan. What's the number, you just quantified the dividend at $3 billion. What's the number that Disney needs to spend on originals for Disney Plus to compete with what Netflix is doing, 15, 16, 17 billion a year? What would be something that would get you excited in 2020?
Well, first of all, you got to reform the question a little bit in that, remember, Disney has 3 streaming services. Like, first things first, like they should just get out of ESPN. Like, just spin it off, get rid of it. Cable, the legacy sports cable network business is not fixable. That is a drag and a management distraction. So I'd get rid of the ESPN business and move that off to somebody else and let somebody else try to fix that business or handle that business and harvest cash flow. But then you've got the remainder of the business, and you've got really 2 streaming services, Hulu and Disney Plus. There's no reason that you really need 2 services, 2 separate logons. Right now they have 3 with ESPN Plus, and they're talking about making a 4th in Star overseas. I would go all in, put them all together, have one service. Dan argues this point. We've been writing about this issue for the last 18 months. Have one service, call it whatever, Disney Plus, Hulu, I don't really care, but have one service. That way you leverage all of the content of the two services together. So it sort of lessens the load that you're talking about in terms of how much. But Disney probably needs to increase their content spend, probably 2 to 3x at least at a minimum, if not 4 or 5x. But they could accomplish a lot of that by redirecting content spend. And so instead of putting all of these movies into movie theaters, maybe it's a 2-week window and then these movies show up on Disney Plus rather than waiting, waiting 75, 90 days. Like that doesn't make sense in 2020. Disney's greatest asset, when you think about the lifeblood of the Walt Disney Company, it's their movies. They should put the movies sooner, really soon, onto Disney Plus. That's what would drive new subs. I mean, think about it. My 87-year-old uncle signed up for Disney Plus because he wanted to watch Hamilton. Like, that is the power of fresh movies on Disney Plus. They should learn from Hamilton and go all in.
Rich, thank you. Great to see you.
Thanks for having me, Melissa.
Lightshed Partners. If they started making movies, Karen, that would only have a 2-week window or so, I would imagine this really changes the face of the movie industry in terms of what is spent on a movie and what is meant by a blockbuster.
Yeah, that's a really good point. I mean, we're seeing such dramatic changes in the movie theater business that started well before the pandemic, and the pandemic just seems to accelerate it. So that dynamic has obviously been hurting Disney as well. But it's interesting, Rich, I read the notes had that 83% of the streaming was Netflix, YouTube, and Amazon Prime. And it makes me wonder what is left for the everybody else. So, I mean, they've got to spend a lot of money. Disney has spent a lot of money to try to build this out. But they also have a lot of debt from the Fox acquisition. So just back to Dan's point, Dan Loeb, absolutely don't pay the dividend. It's not worth it. You don't get anything for it versus what you need the money for.
I mean, again, right now they've suspended the dividend, so it's sort of maybe an issue for down the line, Guy. But do you like Rich's forecast or outlook for Disney? I mean, do you like his prescription for the business in terms of getting rid of ESPN, just writing that business off entirely because it's failing?
Well, they could make. Well, it's failing, but they could turn ESPN to something if they had a hankling to get into the obviously the online gambling business, because quite frankly, that ESPN platform could be tremendous for that. But I'm with Rich on that one. Number one, number two, the great Tom Rogers, who comes on our show all the time, has been outspoken in his questioning of how Disney's going to turn this into a profitable endeavor. He thinks this is 3 to 5 years out. With all of that said, you go back to spring of 2019, 120 had been the line in the sand, resistance on the upside, finally broke out. 120 has been support. We've actually talked about that on this show. In terms of risk reward, where the stock traded down to yesterday is a great entry point. I think you could trade Disney here on the long side, given that support level and given the news with Dan Loeb.
Tim, you're a shareholder. What do you think of what Dan Loeb is proposing?
Look, I think it makes a lot of sense. I'm not surprised that's been brought forward, but the company already has, I think, made it clear that they are conserving the balance sheet, and they're at least taking a more conservative stance. If you look at their last quarter, remember the stock popped on that numbers, and it popped because they showed profitability nobody expected, because they've been squeezing expenses down and I think showing their ability. If you look at Disney Plus, the fact that they are in the bottom end of the 5-year forecast range means that profitability there will come faster. I can't dispute the content need. And by the way, bravo to Netflix, because at least from my perspective, for the first 4 or 5 years they were in business, this was a portal. It wasn't a content play, and it was always a big challenge. If Disney is now competing with that as the hallmark, it's interesting. But I still think, again, the flywheel, as we discussed, is a powerful part of their business, and I think it's still something that's got intrinsic value.
Shepard Smith here. Thanks for watching CNBC on YouTube.